We're going to talk about 1031 exchanges here and kind of how to structure transactions when one of your capital raisers or one of your LPs wants to potentially 1031, or you've got an investor that has money sitting with a qualified intermediary and you want to accept those funds into your new deal. There's a lot of legalities and tax implications, and so we'll talk through that during the presentation. So I think I can share my screen. All right, so let me get that done. Where'd you guys go? I will start sharing it here. All right, can everyone see my screen okay?
Yep, sure can.
Good. All right.
Yep.
Awesome. All right, so again, I already mentioned who I was. We're going to talk about 1031s, how to use exchange funds to build a successful real estate investment deal. So we'll start with the basics, right? What is a real estate syndication? And it's really a pooling of funds through a partnership. It's where, it's a symbiotic relationship where you have a sponsor who is, the kind of driving the deal, right? They're working with the brokers, they're working with the lenders, they're sourcing properties, underwriting it. And then when they get ready to close it, they need capital, right? So capital comes in various different ways. And one way is through a syndication where you have limited partners who pool their funds together to purchase the property. There's a shared ownership of the real estate between the limited partners and the general partnership. The investors essentially become co-owners of the property. But the management rests with the sponsor. The sponsor is responsible for managing the property, managing the asset, overseeing decision-making authority, and essentially executing their business plan of the deal. And also, syndication provides a really good way to diversify your assets because you can invest really little chunks of money in a bunch of different deals and spread that risk around. So obviously the benefits of real estate syndication, of course, is leverage, right? You can pool your investments together and your dollars together to get high value properties and get larger properties. Diversification, we talked about. Building credibility is huge. For those that are looking to get into sponsorship themselves, acting as a limited partner and investing in deals, it gives you credibility. Now, it doesn't quite give you the credibility you need for lenders. You need to really be on a GP team to have that credibility with lenders, and we can talk about how to do that. But it also provides you passive income opportunities. In the industry, we like to call this mailbox money, right? So this is when the property is doing well, and the investors are paid a preferred rate of return. Typically, that money comes in the mailbox, quarterly at least, and the investor really didn't do anything except invest their capital. There's also a lot of tax advantages, and we'll talk about that, especially in the context of 1031 exchanges. But as a limited partner in real estate syndications, you can take advantage of what's called bonus depreciation. Currently, I think it's at 40%. But with Trump in office, hopefully that's going to go back up to 100%. I know that the real estate industry is really pushing hard for that. But that allows the investors to essentially take a paper loss that they can use to offset their gains. Very important strategy, tax strategy for real estate investing. So let's see. Okay, yeah, I'll just make sure I got the right one up here. All right, so syndication entity formation. When we form syndications, we want to typically do them as limited liability companies or limited partnerships. And this entity distinction really impacts how we handle 1031 exchanges. The LLC structure everyone's familiar with, right? That's the gold standard, I think, in entity formation. It allows investors and owners to shield their personal assets from the liabilities of the syndication. And it essentially allows for pass-through taxation where the profits and losses are reported on the individual investor's returns rather than the company's returns. So you don't pay tax at the company level and then pay tax at the individual level. It's all passed through. And that's why investors who invest in syndications, they get a K1 from the entity that owns the property. because they want that profit and loss is passed through. Limited partnerships is the same concept, except you have a general partner um, in that entity, and the general partner can sometimes be liable for certain things, but the limited partners are still having their assets shielded. So they both provide that protection against their personal assets being, used or clocked by a creditor who may come after you. And both offer various tax benefits in a syndication, especially when it comes to bonus depreciation. So, and I structured this presentation really to kind of talk about what are syndications first and give the context, and then we'll move into, well, what's a 1031 exchange and how do we deal with 1031 exchanges in a syndication context. So just as general background, what is a security, right? We only got to worry about this syndication stuff if we're dealing with securities. Well, there was a Supreme Court case in 1946 that defined exactly what a security is, and it's essentially an investment contract that has four important elements. One is the investment of money. Two, it's a common enterprise, right? You're going to go buy this property. That's the purpose of investing the money. The investor expects a share of the profits, right? And this is the big one, solely from the efforts of the sponsor. That's the big distinction between a syndication and a joint venture. If me and Dustin and Hayden, get together and we're all going to put in $100,000 and we've all put in 300 grand and we're going to go buy a property and we're all going to be active in the management of that property. We may designate Dustin as a managing member, but we all make decisions together. That's a joint venture, right? That's not a securities implication. But if Hayden and I give Dustin, our 100 grand and say, Dustin, go buy a property and just send me money when you have cash available, that's a security. So it's really the activity level of the members is what the distinguishing factor is. So here's the decision tree that we created to really go through, deciding whether it's a syndication or not. So is it member managed? Then typically, if it is, it's a joint venture world. If it's manager managed, which most syndications are, then you're dealing with complying with SEC regulations and the like. If that's the case, then we move into Reg D offerings. Reg D offerings are exempt from SEC registration, but you still have to provide notice to the SEC of the offering. And there's a 506B offering and a 506C offering. I know this isn't a syndication specific presentation, but again, I just wanted to give the background. A 506B, you can only have you can have an unlimited amount of accredited investors, but you can only have 35 sophisticated or unaccredited investors, and you're not allowed to advertise. In a 506C, you're allowed to advertise, but you can only have accredited investors. This is the negotiation that the SEC came up with after the Jobs Act of 2012. And so the real distinction for sponsors is, do we want to advertise or not? That's like the first question that needs to be answered. If the answer is no or yes, then we can decide whether we want to do a 506B or a 506C. This kind of just explains again what the exemptions are for syndications. Let's get into 1031 exchanges. So given that background of a syndication and how syndications are structured with limited partners and general partners or managers, and limited partners being limited and really just investing their money, how do 1031 exchanges come into this? Well, what is a 1031 exchange? Let's start with that. It is essentially a mechanism that the IRS code permits investors, or I shouldn't say investors necessarily, property owners, from deferring their capital that they've earned through the sale of a property, capital gains. Now, if somebody sells a property for exactly what they bought it for, and they haven't incurred any capital profit, basically, then there's nothing to defer. But if I buy a property for $1 million and I sell it for $2 million, then I've got $1 million of equity of profit that I need to either pay taxes on or find another property that I can put that money into and defer those capital gains. Now, the IRS is going to get their money. Let's be clear about that. We are just kicking the can down the road, so that you don't have to pay taxes on it right away. But when that second property sells, right, If you don't find another 1031 exchange, you're going to pay taxes at that point. You can find another 1031 and you can just keep kicking the can down the road. But at the end of the day, you're going to have to pay Uncle Sam their capital gains. Now, I've even seen it where, it's been deferred so long that the last guy who's going to pay this tax dies, right? And then the trust of the family has to end up, he's paying it from the grave here. The trust of the family is now paying the taxes on that exchange. So it is a very useful tool in real estate investing. And the purpose of it was really to spur real estate investment by requiring that you purchase a like kind property, right? So it must be similar in nature and of use. And so what that really means is if you have an office building, you exchange it for an office building. If you've got a multifamily property, you exchange it for another multifamily property. Really, if it's general real estate, you got to exchange it for another piece of real estate. I haven't looked into, can you do land and go from land to improved property? I would imagine you can. The rules are pretty loose, but that's the general idea. So, but there are some strict timelines that everyone needs to be aware of. Number one is once the funds are extracted from the sale, and when I say extracted, what I mean is on the closing statement, when you sell the property, that money cannot go to your pocket as the seller. The money has to go to a qualified intermediary. Well, what does that mean? That's really just a third party that is set up to receive the money and hold it and use it for your benefit at a later date for the next property. If it goes to your pocket as the seller of a deal, then you won't qualify for the exchange. It has to go to a qualified intermediary. So once that happens, you've got typically 45 days to identify the replacement property. And then you have 180 days from the closing to close on the new property. Very important timelines. If you miss those deadlines, then you've lost the deferral and you'll have to pay tax on the money. So and what is a qualified intermediary? We talked about that. They hold the money that you're exchanging, and then they deposit it into the new deal. So in the context of a real estate syndication, if we have an investor that has, let's say, $500,000 to invest in a deal from a 1031 exchange, the only safe way, I should say, to do it is through what's called a tenant in common structure. What does that mean? So that means that the entity that sold the property has to become an owner of the real property in the subsequent transaction. So you literally have entities that are the owner of the real property, that they own it in accordance to a percentage interest. So meaning, if Dustin and team are raising $5 million of equity and they have a guy coming in for $1 million, then that $1 million is what, 20% of the equity. So then that $1 million 1031 investor will own the real estate as 20%. They'll own 20% of the actual dirt, and the other syndicated entity where all the other LPs are own the property in 80%. So it's an 80-20 split. And that's really the only way, because you have to structure it as a like-kind exchange. And so what that means is you can't exchange a real property ownership interest for a securities interest, which essentially what a membership interest is in a company such as a syndication, right? You can't sell your property and buy a membership interest in a syndication. That's not like kind. It has to be real property for real property. And so this slide is essentially telling us what that means, and you have to actually record the deed. The TIC owner is listed on the actual deed to the property. Usually there's a TIC agreement that is executed between the parties. The TIC agreement shows who's in charge, right? Who's managing the property, And there are no rights of survivorship in TIC arrangements. And you cannot transfer the ownership in a TIC to someone else without the consent of the other TIC member. So we talked earlier, there's a lot of benefits for using 1031 exchanges for real estate investing. Obviously, deferring capital gains. It's another way to diversify your portfolio. And you can increase your investment value by reinvesting those proceeds. So by spurring on reinvestment, it allows you to grow your portfolio to a larger pie. We kind of talked about this, reinvesting the equity, diversifying investments. And again, I should have said, I don't know, Dustin, if you're managing this, but if there are any questions throughout this, happy to take them. Just put them in the chat, and we can manage the questions. I mean, this is definitely a fluid conversation. So if you guys have any questions throughout this process or this presentation, make sure to let us know and we'll answer them accordingly. Let's see. Let's move on. So there are some potential challenges with the 1031 exchange, and I've seen this play out in real life. One is identifying the suitable property, right? Deals are kind of slim these days, as people know, and it's a weird market. But you have to identify it. Now, identifying it, there is some wiggle room. I mean, you really have to just write it down on a piece of paper and give it to the qualified intermediary, and that's considered identifying it. There's also, and I don't know if I talk about this here, there's also what's called, you can identify up to 3 properties, or also identify up to, I think, 200% of the debt and equity. It's called the 200% rule in your exchange. So if you're not sure which property you want to close on, you can go ahead and identify 3 within that 45-day period. And as long as you close on one of them within 180 days, you've satisfied the requirement. The coordination of bringing in a TIC investor who's doing a 1031 does require a level of expertise, which obviously we are experts at, but it becomes another cook in the kitchen, so to speak, and you've got to manage the quality, the expectations of the investor, the sponsor, the TIC investor, and also the qualified intermediary. The other thing to consider is that not every lender is going to approve a TIC arrangement, right? So that's a big deal. There are some lenders that will not approve more than 2, maybe 3 TIC investors. So you can't bring in, 10 or 15 TIC investors that all have 1031s to do. Lenders just won't do that. It becomes just too cumbersome, and it looks almost like a disguised, tax haven where everyone's trying to avoid taxes, but they're really not owning it as a tenant in common arrangement. So that's an issue. I've seen lenders push back on that. Another issue is the management of the deal, right? If you're accepting a TIC investor, and this is really for the sponsors out there, you're agreeing to get in bed and marry this person throughout the life of the deal. The way I like to structure deals is if a TIC investor is coming into a transaction, and say they're coming in under an LLC, and that LLC does not own any other assets except for this interest, and they're going to now be a TIC partner. What I like to do is centralize the management of the entire transaction. So even though I'm a visual guy, so if we got 2 entities here, right, the management is going to be centralized to the main sponsor's management tree, if you will. So the TIC investor has to be okay with the understanding that its entity is going to be managed by someone else. And again, these are passive investments, so they shouldn't have a pushback on that. But if they do, it could be problematic. Also, if the TIC investor has other investments in that LLC, then it could be an issue because they don't want to have a manager manage their, someone else's or a deal somewhere else. So that's always the first step is, does this LLC own any other assets, or is it just this one passive income opportunity? Key steps: identify the replacement property within 45 days of closing on the relinquished property. You must complete the purchase within 180 days of closing on the relinquished property. This is a big one. The value of the replacement property must be equal to or greater than that of the relinquished property. So if you're selling, you know, a $5 million property, then you've got to find an exchange that value that's valued at that amount. And the other piece of this is, I don't know if I have a slide on this or not. The other piece of it is you've got to replace the debt as well. So the guarantor or the exchange or the TIC member that's bringing the money in, they also need to sign on the debt to satisfy the debt replacement requirements. A lot of people don't understand that. It's not just about the equity requirements, it's the debt requirements as well. So key considerations here, ensure that the syndicated property qualifies for 1031. When you say qualify, I think that really means the sponsor agrees to it and the lender's okay with it. Because we can structure a deal, we can structure a 1031 and an acquisition any way we need to, but you got to make sure those parties understand and approve it. My advice to sponsors is I really don't recommend doing a 1031 on an acquisition if it's less than $500,000. You really want to preserve this for your keystone investors or cornerstone investors that are giving you, perhaps repeat investors or giving you large, $500 or $1 million checks, because it is a lot of extra work that you have to go through. We talked about working closely with the syndication sponsor, getting all the documents, understanding the tax implications, and seek professional advice. Very important. If you're the investor that is investing in a transaction as a TIC member, have the documents reviewed separately. I would recommend that. Minimum investment amount required to participate in the syndication. We talked about that. What is the ownership percentage? So here's something that people don't also understand. In order to maintain the tenant in common arrangement, right? Because a tenant in common arrangement is a specific ownership structure, legal ownership structure. That's different than a partnership. We talked earlier, syndications are partnerships, right? You have limited partners and general partners. The TIC member cannot be a partner in the syndication. What happens if that happens, then the TIC it collapses is essentially the term. And the IRS could, if they came and audited the partnership or audited the property and the distributions, they could determine that the TIC form was not adhered to and could collapse the TIC, and then any 1031 money that comes in would be taxed. Now, have I ever seen that? No, but it's definitely a possibility. And the voting rights and decision making, that needs to be flushed out. If you're thinking of investing in a deal, or you're a sponsor thinking of getting involved in a TIC, you need to decide, are you okay with how decisions are made? Very important. So when you're using syndication, your key steps in structuring a real estate syndication using 1031, you got to structure it as a TIC, which we talked about. The TIC investor returns must correspond to their ownership share. It looks like there's a typo there. So what that means is if the TIC investor owns 10% of the property, then they have to receive 10% of the cash flow. Those funds must be sitting with the QI. They must execute a TIC memorandum of understanding. And then you want to centralize the management. It's very important because otherwise you've got too many cooks in the kitchen, so to speak. And it's going to be hard to just manage the deal. So here's an example of what a TIC would look like. So I don't even see my screen here, but we've got, this is a fund that was managed by the manager. This is a real deal, by the way. And then we've got, group TIC 1, homes TIC, and then dreams TIC. And see, each one of these members owns a percentage ownership in the real property, right? Now, what I didn't put in here, which I should have, is this manager entity should be a line here where this manager entity is going to manage each tick investor. All right, that's the other important part, to centralize that management, as we were talking about earlier. And I think that is the end of my presentation, guys. I kind of flew through it. It's about 12:30. Let's see. Are there any questions that have come up? Anything that you want to discuss further?
Well, I'll see. I guess see if anyone in the audience has any questions. If not, we have a few.
Yeah,
So
shoot. Yeah.
okay, cool. I guess if you have so I wanted to get a little clarification. So if you have a larger 1031, let's just just throw out 10 million, just kind of larger. And you mentioned so. Could you potentially, and you were looking to, go into multiple deals
Mhm.
with that money? Could you close on one deal within the 180 days, and then, or does that whole 10 million have to be placed within 180 days, or is there a grace period after you close one, or what does that look like?
Yeah, so it would be it just depends on when the deal closes, right? So if the clock if it's one 1031, I mean, I'm sorry, if it's one $10 million check from a 1031, you're going to put that in multiple deals. You've got to close on, I believe the rule is you got to close on all of them within the 180 days.
Oh, okay. Okay. Got
Yeah.
it. Okay.
Yeah. Um, what else?
Um, Hayden, do you have a question or questions?
Yeah, I've got one. We've heard this term kind of thrown around or when we're looking at acquiring deals and stuff that some sellers are doing reverse 1031s. So can you maybe
Yeah.
explain what that is?
Yep. Yep. So that, I guess that we would call that like a drop and swap. So I could have pulled up a different org chart, but if you've got you did a typical syndication, and you've made your investors a ton of money, and you've got a guy who gave you $1 million as a limited partner in a syndication, and he doesn't want to pay, you've turned his $1 million into $2 million, let's say, and he doesn't want to pay taxes on that extra million, right? So what you do is you have to then take him out of the limited partnership position, deed the property to him as a tenant in common. And so you basically deed, it's a little complicated, but if it was like Momentum Capital LLC is the name of the entity, right? And then this guy is, let's say, is ABC LLC. Momentum Capital would execute a limited warranty deed, depending on what state you're in, to itself plus ABC LLC as tenants in common. So you're dropping their interest from the LP position to a direct ownership position in the real estate. Technically, that needs to happen really before closing to get some seasoning done to make it not look like you're trying to avoid taxes. But every time I've done that, it's been sort of at closing, right? Because if you do it prior to closing, you've got to then go get approval from your lender. You've got to get the loan docs redone. For larger deals, I have done that. And you just let them know, hey, this closing's imminent. And if lenders will work with you, they'll update the loan docs, they'll update the deed. You get that done, because then you're doing it for different reasons. But that's essentially it. Hey, you drop them from an LP position to a direct ownership position in the real estate. And then at that point, the seller or the grantor under the next deed will be Momentum plus ABC as tenants in common, transferring the property to the new buyer. And then on the settlement statement, whatever proceeds were supposed to go to ABC LLC, this limited partner who dropped into a deed position, that his money will be separated out on the settlement statement and then wired directly to the QI. And so that's how you preserve his exchange. But again, like I said earlier, I would not offer that to the run-of-the-mill retail investor. I would just do it for your kind of your cornerstone or higher dollar guys?
So kind of following up on that, so if we're currently in a syndication right now and we're interested in doing, we're looking to sell and we're looking to potentially 1031 those dollars into, another property, what does that look like? And obviously, if you have, let's just say 100 LPs, not every LP is going to want to, follow the
Right.
1031 probably, but
Yeah, so I've done this as well, and it's very important that we get really sophisticated QI advice. And I actually use a group called Riverside 1031, I think, up in New Jersey. I mean, you may have heard of them. But Len Berkowitz is his name. He's a great friend of mine. He's a tax lawyer as well. So that's why I really like using him, because he can provide some pretty solid tax advice. So there's two ways to do that. And I've done this for clients. If you get approval from everybody,
Mhm.
right, then you can drop everybody into a separate entity, right? And that entity then becomes the tenant in common with the syndication entity.
Hmm.
So they don't have a limited partnership position. They have a direct ownership, and the LLC is a pass-through entity anyway. And so it's disregarded for that purposes. And so that qualifies, as meeting the 1031 exchange requirements. And so if everyone agrees, then you can drop them into that entity and then put that money into a new deal that you've identified, close on 180 days later. If not everyone agrees, then you would leave some investors in the syndicated entity that will get their cash in the ordinary course of business through closing. And then the other ones you put into a separate LP entity that did agree to 1031.
Got it. Okay, cool. Do you, as far as the timing on that, do you have to do that a certain amount of time before
Before
selling the
closing, I
property
mean,
or?
yeah, I mean, ideally you want to do it, 30 days or so before closing, just to give some seasoning to it and make it not look like it's a part of the closing. But, I've never seen it, I've never seen the IRS come back and really question that. I've tried to research, maybe I'll have my summer associates do that this summer, like try to research some cases out there of when the IRS has actually looked at this.
Got it. Okay, awesome.
Kind of along those lines, for the ones that you've done prior to a closing, so during the hold, are there, based on your experience, are there certain lenders that give more pushback than others? Like obviously Freddie and Fannie, for example. Do you have any experience with them or seen what they would do in that instance?
Yeah, I'm trying to think what this, and I was actually, we were on the purchasing side of this particular deal. I can't remember who the lender was. Um, it's mainly like bridge lenders that push back a little bit harder,
Hmm.
than Fannie and Freddie.
Got it.
And CMBS lenders would push back hard as well, because that, when you get into CMBS loans, you're then looking at, they have agency rating requirements and bond rating requirements that just becomes more complicated.
Interesting. Um, and I don't know how much you know about uh DSTs and all that. Can you just at maybe, at a high level, just kind of explain the differences between 1031s and DSTs?
Yes. I don't know a ton about 1030. I mean, about DSTs. I
Mm-hmm.
haven't I haven't actually worked with a Delaware statutory trust. I just find it, I know it's a passive ownership structure that can qualify for a replacement property in a 1031, but I've not actually done that. So it doesn't happen a lot, I think, in the syndication space.
Gotcha. Okay.
Yeah. Have you guys ever done any DST work?
Hmm.
No, I've talked to a few different 1031 folks who um Yeah, I don't know a ton about them. It sounds like it's kind of I think you can smaller 1031s. I know a lot of times we'll go into DSTs, just because what you kind of talked about, because of cost and things like that, you really need kind of a larger amount. But a lot of
Yeah.
the DST guys that I've spoken to, they accept kind of that smaller 50, 100,000 1031 number. And but yeah, I don't know a whole lot I don't understand really the differences. Uh,
Well,
so
yeah, it's like if you take your well, think about it this way. It's a passive ownership
hmm
versus an active role, right? So instead of getting a direct ownership interest in real estate, you can take your money from your syndication and you can put it into a DST and still remain passive,
hmm
right? But the way we structure 1031s, you're still passive. You're just on the deed and you're qualifying for 1031 by owning that like kind property. Um, so that's yeah. I mean, you've got no control over your investment in a DST. So maybe that's one of the other biggest differences. And I'm not sure how much it costs to set up. It seems like DSTs are they're set up by kind of like institutional partners, right? It's not if there was an individual, you know, investor who wanted to not pay taxes on their own money, I would not recommend setting up a DST because that would just be cost prohibitive.
yeah. Got it.
Kind of along those lines, for anybody out there that maybe is thinking about selling a property or interested in doing this, what does that cost look like if this is what you want to do? And then at what point do you recommend them reaching out and connecting with you?
Yeah, I mean, if you're selling a property and you want to consider doing a 1031, then it needs to be you need to engage counsel obviously before the sale. If you're if you have investors and you want to kind of do the drop and swap, ideally I like to be engaged when we have a deal under contract or under LOI, really. If an LOI has been accepted, that's when clients really reach out to me because then I just quarterback the whole process from beginning to end at that point. But if there's someone else doing kind of the acquisition work and we're ready to close, we need to do the corporate 1031 work. I mean, I would say, a month before closing, let's get engaged and start working on the exit strategy, either with the investors or how we're gonna structure the 1031.
Awesome.
Got
Yeah,
it.
absolutely.
Can you mentioned the 200% rule. Could you kind of just explain that a little bit further?
Yeah, absolutely. So there's the three property rule and the 200% rule. So the 200% rule is basically you can identify as many properties as long as the combined value doesn't exceed 200% of the value of the property you sold.
Mm,
Hmm.
So
right.
you're not limited to three. So if you sold a property for $1 million, you can identify as many properties as you want as long as it doesn't exceed $2 million.
Yeah.
You know,
Got it.
and that really is a way to kind of, hedge against this ability of finding a good property and closing on it, and having to identify it in 45 days. I mean, I get emails all the time of like, hey, your identification, time period is up like in a week. Like, have you found a property or not? And as you guys know, I mean, it takes a lot to underwrite, identify, a
Mhm.
property and commit to it,
Mhm.
you know.
It looks like Sherry had a question. It's in maybe said, do you do 1031 exchanges with OZ funding?
With opportunity zone
Yep.
funding. I mean, I believe you can. I have not done that myself. The opportunity zone funding is really kind of a corporate structure and it requires certain levers within the corporate structure to be used on the property. Um, I would imagine you could do a 1031 into an opportunity zone fund as long as the 1031 entity or investor has a direct ownership in the real property, and likely also agrees to abide by the opportunity zone funding requirements. That would be my guess.
Got it. Okay. Yeah. Anybody have any other questions they want to ask Todd while we have him?
And Todd, if you want to go to that last slide that had your information on it, if anybody listening or anybody watching after the fact wants to get in touch with him, obviously here's all his contact information, like Dustin mentioned at the start. We've been in close contact with Todd for a few years now, and he's definitely the expert on all of this. So, if it's okay, Todd, we're happy to send out the slides as well to
Yeah,
people that registered. And if they've got any questions after the fact, obviously your information is there.
100%, guys. Yeah, I really appreciate the opportunity. And these are the kinds of conversations that are good to have. You guys are obviously a great group, know what you're doing with multifamily investing, and anybody looking to passively, like I said, get that mailbox money, this is the group you want to work with.
Sounds good. Yeah. Yeah, I'm not super familiar with Atlanta, Charles, but yeah, probably lots of the Peachtree streets.
One of the
So,
many Peachtree
yeah.
streets. Yeah. I'm on the actual one. Um,
Sounds good.
uh,
Well, great. Yeah, really appreciate your time. Yeah, please feel free, anyone watching this to, reach out to Todd. He's a, great resource. You got 1031 coming up. Feel free to reach out to Todd, and, him and his team could, hopefully be able to help. So, appreciate your time, Todd. Hope you guys have a great day. And yeah, we'll talk soon.
Sounds good. Thanks, guys.
You guys,
Thank you
take
guys.
care. Bye.